The IRS lets you erase your capital gains tax with one move, and it has nothing to do with a 1031 exchange. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no taxes using my zero tax blueprint. You don't actually need a 1031 exchange to soften the tax hit when you sell a rental property. No qualified intermediary, no 45-day identification window, no 180-day close. Just sell, buy something else, and let depreciation do the work. Investors call this the lazy 1031. And today I'm breaking down exactly how it works, where it falls short of a real exchange, and when it's actually the smarter move. When you sell a rental outright, two things hit your return: depreciation recapture under Section 1250, which is taxed at up to 25%, and long-term capital gains on the appreciation, taxed at 0, 15, or 20%, plus the 3.8% net investment income tax if you're over the threshold. That's real cash going out the door in the year of sale. A 1031 exchange defers all of it by rolling your gain into a replacement property, but it comes with strict rules: a qualified intermediary holding the funds, a 45-day window to identify replacement property, and a 180-day window to close. Miss any of that, and the whole exchange collapses. The lazy 1031 skips all of that structure entirely. Here's the mechanics. You sell your property the normal way: no intermediary, no exchange paperwork, and no deadlines. You recognize the gain and the recapture on your return like any other sale. Then separately, you take the proceeds and buy a new investment property on your own timeline whenever you're ready, of course, as long as it's in the same year, with whatever property actually makes sense for you. The tax benefit comes from what happens next. That new property comes out with its own fresh depreciation schedule. If you pair the purchase with a cost segregation study, you can accelerate a meaningful chunk of that basis into bonus depreciation and shorter life components in year one. That fresh depreciation creates a large paper loss that offsets other income, including, in the right structure, the recapture and gain you just recognized on the sale. You're not deferring the original gain the way a real 1031 does. You're generating a new deduction large enough to absorb it. A few reasons investors deliberately go this route instead of doing a formal exchange: it's timing flexibility. There's no 45-day identification clock and no 180-day close deadline. You can take your time finding the right property instead of being forced into a mediocre deal because the exchange clock is running out. There are no like-kind restrictions on structure. You're not bound by exchange rules about how title has to be held or how financing has to work. You're just buying a property the normal way. Also, you have access to the cash in between. Since there's no qualified intermediary holding your proceeds, you have full access to the funds the moment the sale closes, which is useful if you need liquidity for a down payment structure, a 1099 tax payment, or just flexibility before redeploying. Simplicity, no exchange agreement, no intermediary fees, no exchange-specific reporting on Form 8824. This is the part people skip past, and it does matter. A real 1031 exchange defers 100% of the gain and recapture, dollar for dollar, as long as you follow the rules. The lazy 1031 only offsets what your new depreciation can generate, and that's not automatically a dollar for dollar match. If your gain and recapture total $150,000, but your new property's cost segregation study only generates $90,000 of first-year accelerated depreciation, you still have $60,000 of taxable gain hitting you this year. Now, picture that same $150,000 liability, but you buy a property or structured a cost segregation study aggressively enough to generate the full $150,000 in year one depreciation. Same sale, same tax bill on paper, but this time it's fully wiped out. That gap between $90,000 and $150,000 of depreciation is the entire ballgame with this strategy. It's not a guarantee, it's a target you have to actually hit. There's also no built-in requirement that the new property even be similar in value, which is exactly the flexibility that makes this appealing. But it also means you have to run the math yourself instead of relying on exchange mechanics to handle it automatically. This tends to work best when you're buying a replacement property with significant cost segregation potential, a larger multifamily, a short-term rental, or a property with a lot of value in short life components like appliances, flooring, and land improvements. The bigger the accelerated depreciation you can generate, the closer this gets to matching what a real exchange would have deferred. It also makes sense if you value timing, flexibility, and liquidity access more than guaranteed full deferral, or if the property you're selling doesn't cleanly qualify for exchange treatment in the first place. Now, where it doesn't make sense. If your replacement property doesn't generate enough depreciation to offset the bulk of your gain, you're just taking a tax hit with extra steps. The lazy 1031 isn't a loophole and it isn't magic. It's a depreciation strategy dressed up to do a job a real exchange usually handles more completely. Used with the right property and a real cost agrees to study behind it, it can get you most of the way to what a 1031 would have deferred without the deadlines. Used carelessly, you're just recognizing a big gain and hoping the math works out. Before you decide between a real 1031 and going lazy, run the actual numbers with your CPA. The depreciation map has to justify skipping the deferral, not just sound good in theory. Subscribe to the channel for more strategies like this every week.